The LIBOR scandals. LIBOR was designed initially as a survey of interbank lending rates, but soon became a key determinant of short-term interest rates with far-reaching significance. More than $500 trillion of derivative contracts have payoffs tied to it, and many $trillion of loans and bonds with floating interest rates linked to LIBOR are currently outstanding. LIBOR is quoted for loans in 5 currencies: the US dollar, yen, euro, UK pound, and Swiss franc, for maturities ranging from a day to a year, although 3 months is the most common. However, LIBOR is not a rate at which actual transactions occur. Instead, it is just a survey of estimated borrowing rates, and this has made it vulnerable to manipulation. Several large banks are asked to report the rate at which they claim they can borrow in the interbank market. Outliers are trimmed from the sample of responses, and LIBOR is calculated as the average of the mid-range estimates. Over time, several problems surfaced. First, it appeared that many banks understated the rates at which they claimed they could borrow, in an effort to make themselves look financially stronger. Other surveys that asked for estimates of the rates at which other banks could borrow resulted in higher values. Moreover, LIBOR did not seem to reflect current market conditions. A majority of LIBOR submissions were unchanged from day to day even when other interest rates fluctuated, and LIBOR spread showed surprisingly low correlation with other measures of credit risk. Even worse, once the market came under scrutiny, it emerged that participating banks were colluding to manipulate their LIBOR submissions to enhance profits on their derivatives trades. Traders use emails and instant messages to tell each other whether they wanted to see higher or lower submissions. Members of this informal cartel essentially set up a favor bank to help each other move the survey average up or down depending on their trading positions. To date, more than $6 billion of fines have been paid, among them, Deutsche Bank, $2.5 billion, UBS, $1.5 billion, Royal Bank of Scotland, $1.1 billion, Rabobank, $1 billion, and Sogen, $600 million. But government fines may be only the beginning. A federal appeals court in 2016 ruled that private lawsuits involving antitrust violations may proceed. Borrowers paying an interest rate tied to LIBOR argue that they were harmed by the collusion of participating banks to coordinate rates. Several reforms have been suggested, and some have been implemented. The British Bankers Association, which until recently ran the LIBOR survey, yielded responsibility for LIBOR to British regulators. LIBOR quotes in less active currencies and maturities, where collusion is easier, have been eliminated. More substantive proposals would replace the survey rates with ones based on actual, verifiable transactions, that is, real loans. British regulators have expressed their wish to phase out LIBOR by 2021. Two primary contenders to replace it are SONIA, Sterling Overnight Interbank Average Rate, an overnight interest rate in the UK market, and, for US dollar rates, SOFR, Secured Overnight Financing Rate, the rate on repurchase agreements on Treasury securities. These proposals leave some important questions unanswered. When LIBOR is phased out, what will happen to LIBOR-based long-term contracts with maturities that extend beyond 2021? For example, LIBOR is the most common index for adjustable-rate mortgages, most of which have maturities of 30 years. And because SONIA and SOFR are only overnight rates, what will replace the LIBOR benchmark for longer maturities?